lot. I think the mistake a lot of people make is they look at the wrong time frame. They're trying to figure out the next 3 months, 6 months, or even the next year, and they get wound up on what I refer to as the data point du jour, right? Every day, the media blesses us with another economic data point that's either good or bad. The market rallies or goes down, and not insignificantly, 100, 200 points in the Dow. Like that matters, right? And it's noise. It's noise in the system, but we're fixated on it, right? We try to zig and zag. So number one, you got to broaden your horizon, your investment horizon, and think the next 2-3 years, which we would consider kind of the intermediate term. When we look out over the next 2 to 3 years, we're actually positive on the equity markets. The fear and greed thing is a powerful driver, and right now the fear factor is driving emotion and driving decision making, and a lot of people are conservative and just feel it's too risky to be back, in the stock market, but yet they'd be willing, to your point, to go buy a treasury bond, for yielding 1.6% ish, and basically losing money in real terms. And if that rate backs up, you'll actually lose money because the price will go down as the yield backs up. Right. So we're saying, number one, around 1,300 on the S&P, which is what we focus on. We think that's a good time to be building back positions in equity. Again, taking that longer term horizon. We have a theme that we call getting paid to wait. And what that means is, you get a return two ways. Number one, through the appreciation of the asset. Stock prices go up or bond prices go up, or commodity, whatever it is you're doing. Or you get paid a yield, through the dividends in common stock or the coupon on a bond. So number one, we're saying whether it's equities or fixed income, get paid to wait. Because we think we're going to see a lot of kind of gyrations, but pretty much no real trend upwards for a period of time here until things sort out. But if you're getting a good dividend and a growing dividend from these big multinational companies, and by the way, these companies benefit from that 3% global growth rate because they're exposed globally, that's a good thing, and you're getting paid in corporate bonds or high yield bonds, or even in some cases, we like munis too in selected areas, then you're getting some return today, then ultimately when the fundamentals start to kick in and get more fully discounted, you'll get the appreciation component as well. So we would say begin the process of slowly building up positions again in equities. If you're in